Good morning, and welcome to Frost PLLC's Roadmap to Revenue Recognition. Thanks for joining us. I have today Brian Ettehad, Senior Manager in our Assurance Department, and I'm TJ Boyle, who's Head of our Assurance Department. Glad you guys could join us. Our plan for today is to go through the new FASB Revenue Recognition Standard as a high-level overview to understand what all's going on and what all you may need to do to think about as it affects your companies. Brian, this has been talked about a lot. I know I've spoken on it numerous times. Why is this so important?
Well, revenue is one of the more important metrics out there for people, just decision makers within, different industries, management, regulators, users of the financial statement, auditors, all look at revenue. It's top line on the financial statements, on the income statement. People tend to look at it more as an indicator of a company's health. Also, they look at trends in revenue. They like to see revenue growth versus revenue declines. So for those reasons, revenue is very very sensitive to anybody that may be perceived as a user of the financial statements.
Well, so one of the questions is, how did we get to this spot? Why are we making changes? What's wrong in the past? What's going on historically? So even though, as Brian mentioned, revenue is one of the most important line items on the financial statements to look at companies and analyze growth, it really hasn't been as well developed as maybe certain other areas on the balance sheet and the financial statements, the income statement. So with that said, it was a lot of very industry specific, very narrow scope guidance that was going on. So it made it overly complex to some people and made it very difficult to look at things, even to the point that many times companies in different industries might have a relatively similar transaction, but might be looking at it from a different point of view, might have different accounting treatment. So when we look at the current overall guidance, a few years back, the FASB created the Accounting Standards Codification that really brought together approximately 4 main standards that had been out there. One being the Concept Statement number 5, and then Concept Statement number 6. Both of those were very broad in their scope. Fast forward a number of years and you get to some of the topics from the SEC. The SEC had a staff accounting bulletin, and then it followed it up with one that's probably the most widely known as SAB 101, which provided the four criteria of revenue recognition. And you'll hear these as we're going through, maybe some similarities. And the 4 criteria were always persuasive evidence of an arrangement, delivery has occurred or the services were provided, the selling price is fixed and determinable, and the collectibility is reasonably assured. Now, as we go through that, I think we'll hear some similarities to that, but in much more detail. And that's really been what we're going to hear overall from this guidance. Brian, anything else that you thought of as you were going through?
It's really more principles based. And to regurgitate what you said earlier, it's less industry specific. There's so many specific types of revenue, whether it's product sales, real estate, construction contracts, agriculture, oil and gas, airlines, so on and so forth, have their own particular guidance that they have to follow. Cable television companies, just for example. And so what the FASB and also the International Accounting Standards Board wanted to do was try to streamline this a little bit. We hear that term a lot, and some people I think are a little bit apprehensive about it. But the idea is that if you're moving from industry to industry, you should be able to recognize revenue consistently, regardless of what business space you work in.
Yeah, sometimes I think most of our clients, when they hear the word streamlined, FASB is not what comes up to mind, especially when you have a 200 to 300 page new standard that comes out.
Some specific issues, that come up irregardless of industries, just whether you've got non-monetary transactions, receiving equity, for example, as compensation, any sort of sale of future revenue, milestone method accounting, installment method of accounting. So the idea is to kind of get away from all these specific types of guidance and go to, again, what we call a more principles-based, literature.
Well, and I think one thing, and we'll see this as we go through the hour, is when you have principles-based accounting, you also run into some judgment issues, and we'll see that in a few more instances as we're talking through this day and what we're going to see. What were the goals of the new guidance? So the goals cited by the FASB: removing inconsistency. Like we said, you might get something in one standard that doesn't necessarily make sense with another. More robust framework. This is definitely robust. There's a lot of examples. There's a lot of ways to look into this. The goal is typically always, when you see what the FASB is coming out with, whether it's leases or revenue, it's to improve comparability. You want to be able to look at one company and see that they're doing it the same way another company, whether it's in another industry or comparable industry. Also, and we'll see this particularly when we get into the disclosure section, provide more useful information. FASB hears from users of the financial statements. They want more information, whether it's breaking down the revenue stream, understanding really what is coming out of the revenue stream.
If you look at your audited financial statements now, you have to go to note 1 or 2 to go to significant accounting policies. And normally there's just a little bit of blurb regarding revenue recognition. And basically what you see with most people is it regurgitates something similar to the 4 principles that TJ cited earlier. So in that regards, they want to give the user a little bit more background so they can understand really how is the company generating its revenue.
So who's affected? Well, this is revenue. So this is something that will affect just about everyone. Anyone who has a business, who has an organization, will have to look at this in one way or another. Now, it's possible it won't affect your debits and credits, but that doesn't mean it won't change your disclosures. Brian, who's some industries that you see may have some bigger impact than others, or where might you see people need to be looking at?
Some good examples would be contractors, construction companies, just because they recognize revenue over time. There's always been a great deal of subjectivity, which TJ kind of touched on earlier, with regards to how far in the process are you in terms of being able to recognize revenue. Financial institutions that, in many cases, a lot of times we think of the financial institutions just earning interest, but oftentimes a significant portion of their income comes from fees. And so it becomes a matter of when are those fees earned, whether they're providing fees for banking services or mortgage origination. One example I read about was actually when banks sell foreclosed real estate, for example. At what point have they met that milestone, if you will. So it's important for everybody to realize that there will be some impact on your business because it's less industry specific and it's going to be more principles based and what if based. And the good thing about the FASB, I will point out, is that it has numerous examples. You'd be surprised if you hadn't looked at it, how many different, kind of if-then scenarios they've come out with for similar arrangements, but not exactly the same ones.
Yeah, very few people will probably find they have their exact scenario, but there is a lot that you can see the similarities between. So let's get into the meat of the new standard. Let's talk about this. So what are the new principles? Well, before we get into the individual details, I'll just give you the high level. So the main principles are identifying the contracts with your customer. That's the first one. Identifying the performance obligations in the contract. Determining the transaction price. Allocating the transaction price to your performance obligation. And then finally, you will recognize the revenue when or as the entity satisfies his performance obligation. And on the surface, a lot of these things maybe sound pretty easy. That sounds pretty simple. But as you get into it, and as Brian's really going to focus and take a deeper dive into each one of these 5 principles, you'll see that they're not always as simple as you may think just on the surface. So Brian, I'll let you start going through the individual principles.
Sure. The first principle, as TJ mentioned, was identifying customer contracts. And one thing to look at is whether or not there's approval and commitment between the parties. Now, you may say, in my business, well, I know, what contracts I have, or gosh, we sell widgets to our customers. We don't really have contracts. Well, one thing the literature points out very early on is that the contract does not have to be written. It doesn't have to be a formal signed document. It could simply be, especially now that we're in 2017, just an email exchange saying that you've committed to, buying X number of widgets over a certain amount of time at a certain price. So keep that in mind. It could be verbal. It could be something you guys or gals determine just via telephone call. So just about every sales transaction or true sales transaction is viewed in the literature as a contract. And you'll see the term contract, much like the lease accounting pronouncement that came out last year, where they use the term contract and not lease. So the other part is identifying the rights of the parties. For example, in the literature, you're going to see the term entity that would most of the time refer to the seller, and then obviously the other party oftentimes would be the customer. And so you're looking to identify whether or not there's rights and some sort of obligation between the two parties. Third step would be identifying the payment terms, whether you're paying on a variable basis or some sort of fixed price contract. And then, fourth would be whether or not the contract has commercial substance. That kind of gets into the next part, whether or not there's an actual obligation between the two parties. And then fifth, this is kind of like the principle about probability of collection being reasonably assured. That would be, is it probable that the entity will collect the consideration to which the entity is entitled in exchange for goods and services?
Well, what do you see? It also sounds like, one of the main things that came out of that is, sounds like the people in accounting are going to really need to get in touch with people in sales.
Sales, yes.
Is that one of the things you recommend that maybe you can?
Absolutely. I mean, everybody really needs to understand what's their pricing model. And I know a lot of people in finance, particularly, have a good understanding of their operations. We've noticed that as auditors over the years, but it's going to require a great deal of communication, similar to what we've mentioned and other firms have mentioned with the lease accounting. You're really just going to have to get your arms around all the different, and I won't use the term contract, let's just call them arrangements for the time being. Important point to point out too is contracts or arrangements don't exist when either party can unilaterally cancel. So you need some sort of firm commitment between both yourselves and your customer. And therefore, it must have enforceable rights and obligations, i.e., you're obligated to provide a product and your customer is obligated to pay for it. The other thing, too, to point out is that contracts can be combined when they're negotiated with a single objective. And what that means is I could have a contract, for example, to provide you a product. This may be one of the more common examples. Say I'm providing you software, hardware, something like that. But at the same time, I'm also providing you a service to maintain, say, that software, hardware. I mean, think of any sort of product like that where you're required to fulfill an obligation to your customer over time. And so therefore, consideration paid for one contract may or may not be dependent on consideration paid for the other. I touched on what a performance obligation was just a moment ago, but the definition is a promise in a contract with a customer to transfer goods or services. Only account for each performance obligation if it's distinct. And that gets into what I was touching on earlier. You may have a situation where you're required to provide, so many widgets. We use the term widgets in accounting.
We're going to have to find a widget.
We have to find something better.
Yes.
But just, think about how this kind of tailors to your business. But over time, maybe you're committed to providing that product over the course of a year. Say it's, say you install an air conditioner. I'm just thinking of an example. But you also sold a service contract along with that product. So you really kind of have to look at those two different contracts, whether it's the initial agreement to provide, say the air conditioner, but the service contract really is one contract because you wouldn't have one without the other.
Well, and I think that's really important. What you're bringing up is people should look at where might they have given something for free, and where is there a free service being given with that product, but it requires a performance, right? There's something that goes along with that. So yeah, that's a very good point.
Another good thing that we could probably touch on too is just kind of the implicit versus explicit.
Mm-hmm. So that's one thing to look at, and the explicit is very easy to understand inside of somebody's contract. So if you have a situation where in the contract it specifically says you have a maintenance agreement, well, that's pretty easy to see and be able to break out. But where you bring up a good point is with the implicit side, right?
But where you've essentially provided a service, it's implied along with the original contract. I wouldn't necessarily say for free, but you haven't necessarily broken that out and explicitly stated. You've only implicitly stated that you're willing to provide that service.
That's right. It's pretty much accounting doesn't let you get a lot in for free.
No,
there's always some monetary value that should probably be assigned to it. So there is commercial substance, and that's what you have to look at is there a history? Are you going to perform on this? And that's again where it comes back to, like we said earlier, you're going to have to take a look into your practices and use some judgment. Is it really something that is going to affect your bottom line? How do you need to account for that?
Sure. And so that kind of leads into the next principle, and that would be determining the transaction price. Many times the product or the contract price may be fixed, but oftentimes, and where there's a great deal of subjectivity, and we as we review this literature, kind of looked at where it's going to impact the most people, and that's where you've got variable considerations, and that's where you're recognizing revenue over time or over the course of providing products or services. Also, the other factors to consider are, the estimates of this variable consideration, whether or not there's a significant financing component, and any sort of non-cash consideration that you may provide as part of this obligation. So, in terms of variable consideration, an entity shall estimate the amount of consideration to which the entity will be entitled. And in that case, you're really doing, what would you say, I wouldn't call it your best guesstimate, but it's supposed to be based on the facts and circumstances when you enter into the agreement.
That's right. You're going to have to use a lot of judgment.
What's
most likely to happen?
What's most likely to happen?
That's really what we're looking for.
One thing we did want to point out, too, kind of leaning into that, is if you know that you're going to end up accepting less than what you may be initially priced because of, a variety of factors, either, the entity will take some sort of discount, maybe volume discount, maybe just a simple terms discount because they're going to pay faster, or that they may pay slow and still take the discount. I mean, we've seen that a lot over the years just working in auditing. If that's the case, you wouldn't get to recognize the full amount. If they're going to take a 2% discount, if they pay within 30 days, just because that's what they do, and they're your biggest customer, and they have that sort of leverage over you, then you don't get to recognize, $1 per widget. You're only going to recognize 98 cents. The other thing too is if you know that there's a possibility that they cannot pay the full amount, you have to factor that into. So this kind of gets into the principles-based topic or item that we were alluding to earlier. It really relies on your judgment so much more than.
And reality is a lot of these things aren't necessarily different than what you may be doing today. If you didn't think a customer could pay the full amount, you should have been reserving for that. So you may think, well, I'm already seeing some similarities, so it may not be as big a change as what you had originally thought, but there are some differences that you will see, especially with the variable consideration. Turn it back to you.
Sure. Well, and diving deeper into this subject, variable consideration is estimated by two principles or two factors: the expected value, that being the sum of probability weighted amounts and a range of possible consideration. So what you're looking at is what's the most likely scenario in terms of what you're going to be paid. Is it going to be the full amount, 100 cents on the dollar, or are you more likely going to be paid based on your past history or lack of history with the customer, a reduced amount? So what you're going to ultimately record is what you consider to be the most likely amount within the range of possible consideration, which to some degree we're already doing that. I mean, you weren't supposed to recognize revenue unless collection was reasonably assured and the price is fixed and determinable. So this is really in some ways just a way of kind of regurgitating that to maybe, perhaps, I don't want to say a little bit more modern times, but things have become a lot more complicated since some of these original pronouncements were written, 30 years ago. One other point that we want to make too is that you should apply these principles consistently throughout the contract. As long as you know that to be true, you shouldn't, kind of cherry pick how and when you apply these sort of discounts and other factors. You want to include variable consideration only to the extent that it's probable that a significant reversal will not occur. So you must consider the likelihood and magnitude of revenue reversal. If I know that I've sold a product and there's a good chance that there's going to be returns or allowances that are going to have to be made, there's a risk of maybe you sell fresh product, for example. Maybe it's produce, maybe it's eggs, chickens, and there's a possibility that a percentage of that's going to be essentially discounted or written off for whatever reason. Then you would have to factor that into your judgment. So, and again, those are all based on what we consider to be outside influences. Could be markets, could be weather, those sort of factors all come into consideration. Previous experience again with a customer. So you kind of have to factor all of those ideas or factors into your consideration.
Yeah, it's back to, like you said, it's back to using judgment, but it's using historical factors. You should be able to look at what have you done in the past, using those past variables, and then looking out for the future in your current contracts. What do you reasonably expect will be collected?
So throughout time, you'll have to reassess your variable consideration. What the literature says is that you should revisit this topic at the end of each reporting period, whether that's the end of the month, end of the quarter, etc., and make what they refer to as a faithful representation of the circumstances present at the end of the reporting period. So that goes back to what TJ was saying. It's a judgment call. It's a significant estimate, but it's also a judgment call.
Yeah.
Another factor to consider too is whether there's a significant financing component. Most of the time with trade receivables, those have payment terms of 30 days, 60 days, sometimes 90 days maximum. So you would want to look and see if there's a significant incentive either for yourself to finance something over a longer period of time, or for your customer to pay over a significant period of time. And literature defines a significant period of time as more than 1 year. And when you do have an obligation that stretches out more than 1 year, you would have to report that at fair value, which is increasingly a term that's peppered into all the different pronouncements now, and that's really where our profession's heading is reporting more and more at fair value. And so in that case, you would have to discount any sort of obligation.
Brian, when you're talking about the variable consideration, one of the examples to come back to is volume discounts.
Yeah.
A lot of times people sell a product with a volume discount. Maybe it's for the next year. If you sell, go back to our widgets, you sell 1,000 of a product to a customer. If they buy 1,000 of a product, then they'll reach this volume discount, and maybe it gives them 5% off the entire purchase price, going back to the very beginning. Well, if you look at it, again, making that judgment call that your customer is only going to buy 500, you wouldn't take any discount, right? But if during that process over the year, say 6 months in, something's changed in their business, they've increased their product purchases, you would then need to reevaluate, go through the process, and take those, everything you're selling forward would come with that discount, plus you would retroactively go back and make an accounting change for the ones that you had already sold. So that's a key thing to look at if you are anybody who sells in a volume discount world, or any kind of price concessions that you may give over time, is to continue to reevaluate that. And how does that potentially affect previous contracts or previous sales?
You'll want to do that at the end of each reporting period. Another item to consider, much like the financing component too, was if there's any sort of non-cash considerations, which, similar to a volume discount. Again, you would measure that at fair value, and if fair value cannot be reasonably estimated, then you would reference to the standalone selling price. The next and the third factor, or principle, if you will, is how to allocate the transaction price. Most of the time, or many times, you're going to have essentially one contract or one agreement to provide consideration. However, though, when you have multiple agreements that are either rolled into one or stand on their own, you should allocate the transaction price between each performance obligation based on your, again, best estimate, i.e. judgment of what those are worth. So the first step would be to determine the standalone selling price. The standalone selling price, again, is what you would sell that product, i.e., good or service, to the customers by themselves. If it's not observable, you must, again, estimate, use your best judgment. And again, if those estimates change, over time, then you would need to update and modify your recognition at the end of the reporting period. There's several different methods to determining standalone selling price. One is the adjusted market approach. 2 is cost plus margin. And 3 is residual approach. A combination of these methods may be needed in order to estimate the standalone price.
So it seems like the goal out of, when you look at the different standalone pricing methods, is really to come up with a way of ratably allocating your overall purchase price. So I guess an example with that may be, if, like we said, with a maintenance contract along with the sale of a product, how much is that, if you're looking at the market approach, how much are each of those worth on their own?
Oh.
And then the same situation may be looking at, well, do they have a cost? How much do they cost you to look at a margin approach? So looking at it, one, from the market side, what's the customer willing to pay? And then 2, you could also look at it from your own these prices and these values across the different selling prices, which is actually pretty fair. I think they've come up with some good methodologies that gives you some flexibility for what's best for your business and easiest maybe inside of your own account.
Sure. The other thing too is discounts must also be allocated proportionally to any and all performance obligations associated with the contract, unless evidence exists that discount is specific to just one of those agreements.
So would that be, I guess from that example, if it's specific, would that be if the maintenance contract, back to that example,
sure,
you wouldn't ever discount that maintenance product, but you do have evidence where if you sell the actual product on its own, that you many times discount that, but you don't normally ever discount the maintenance that goes along with it.
Right, or if I've explicitly given a discount for that to the customer, in that situation, then I would apply that discount just to the maintenance contract.
Okay.
So, again, recognizing revenue when or as the entity satisfies the performance obligation. One thing that we do talk about is because of the variable nature, many times obligations will be satisfied over time. There's three essentially concepts that are related to this, where this would be met. And one would be when the customer simultaneously receives and consumes the benefits provided as the entity performs its obligation. The other example, or the second example, would be if the entity's performance creates or enhances an asset, i.e. think about work in process or construction in process, that a customer has control as the asset is created or enhanced. The third principle or concept is much the same as the second one, and that'd be when the entity's performance creates or enhances an asset that the customer controls. As the asset is created or enhanced, an entity has an enforceable right to payment for performance completed to date. So again, think of a construction contract, for example. If I'm 60% through, do I have an enforceable right to payment for 60% of that contract?
Mm-hmm. Yeah, and I guess when you come to the allocation, I think of this, the satisfaction of the performance obligation. Sounds pretty simple if, again, you're doing a point-in-time sale. If I deliver a product and I'm done, that sounds pretty easy.
Pretty simple.
But when you get back to the work in process, and that doesn't, a lot of people think immediately of construction, but you may have some service contracts that are being done.
Sure.
If they're done over on a fixed price fee. So there's a number of examples there where you may want to consider what is it that you're doing and does it fit into this model, and how have you actually satisfied the performance obligation?
Other presentation matters to consider. If a customer pays prior to receiving goods and services and has a right that is unconditional, then that entity would record that as a liability. Think of, if I prepaid for a product, for example, the person that has the obligation to perform would not record that as revenue, even under current literature, as a sale in the income statement. Instead, they would record it on the balance sheet as a liability. If an entity likewise performs its obligation prior to being paid, you would record a receivable, just as you always would have. Any future write-down of that receivable would be expensed, much as the case as it is now. But again, you wouldn't record a receivable for more than what you were expected to receive as of that date based on your judgment.
And sometimes I think of these, when you talk about these other presentation matters, these are really just good reminders of what we've done in the past. One, having a receivable. If you receive money before you've done the service, you've got deferred revenue, which is a liability. So a lot of times they do come out with new standards, but they have a lot of what's in the old standards and reminders of what's going on. Now let's maybe get to the part that if you looked at it, you've looked at what we've talked about and what we've been saying so far, and you said, I don't think this is going to have a big impact on my business. The new disclosures will have some impact. I can't see anybody getting around not having new disclosures because they were designed to increase people's disclosures. I think people have been surprised that some public companies that have already come out in their Qs have had 2 to 3 pages, and I heard somebody say, I was surprised it was only 2 to 3 pages long. So not everybody will have that much to disclose, particularly on the private entity side, but we'll get into that now.
Yeah.
Brian, why don't you take over?
But this kind of gets back into what we were talking about earlier, and that was saying if you read the financial statements nowadays, you've got 3 or 4 lines in the significant accounting policies basically saying, this is how I recognize revenue. Now you must disclose significant information to understand the nature, amount, timing, and uncertainty of revenue and cash flows, which that implies a great deal of subjectivity and judgment. The entity is also responsible to provide enough detail for an educated user of the financial statements to have a clear understanding of that, but also not provide too much information as to it would obscure useful information.
Well, yeah, one thing I know I get questioned about this and been asked, and I get this in a lot of other things is, well, where's the bright line? What do I have to do? And that's one thing that's not going to be, it's not told specifically. Here's the numbers. Here's what you have to do. That's not lined out as standard. So it is more about that judgment. What does a user have to, what would a user want to know? And what's reasonable to give to a user?
And so again, it's principles based. They want to talk about your product lines, or they want you to talk about your product lines. Geography, meaning what markets do you sell into? Where are your customers at? Customer type. Are you selling, for example, let's say you manufacture food. Are you selling to retailers? Are you selling to wholesalers? Are you selling to restaurants, for example? You know, I mean, what's kind of your breakdown? What's your customer mix? And then what's your contract type? Are you selling on fixed price contracts for an extended period of time? Or are you selling based on, let's just say, we'll change widgets to chicken or eggs, just because we work in that space. Are you selling eggs based on a market price, such as an Urnerberry price at the end of the week or at the end of the month? Or have you committed to a fixed price contract for, shell eggs over 3, 6, 9, 12-month period?
Yeah, it's really looking at what could be different and what could be a user. Do you have, you look at the service industry. If you're a service industry, again, going back to that potentially fixed price versus variable prices, may have some of that to look at and disclose. But again, these are all things to think about disclosing and how you're going to disclose it.
So again, as TJ said, it's not so much bright lines, but concepts. Another area to focus on is explaining the timing of satisfying those performance obligations and the timing of payment. And that gets back to whether or not you're requiring your customers to pay, every 30 days, every 60 days, that sort of thing. So that's another concept to focus on. Other factors that can impact your disclosures are business combinations, i.e., did you acquire another company, merge with another company during the course of the year? How does that impact it? Cumulative catch-up adjustments, and that goes back to earlier when we were talking about revising your estimates at the end of the reporting period. If you do have to record a material, what the literature calls cumulative catch-up adjustment, that factor would also need to be disclosed in your revenue recognition policy. If there's any significant impairment of a contract asset, i.e., meaning you're going to have to write down receivables, for example, or there's the possibility that a significant contract may not be collected on in the future, that also would be something that we disclose. And also changes in time frames. Are you now selling product to a customer over a longer time frame, shorter time frame, going to a spot price? All those sort of things. So when TJ said 2 to 3 pages, that's probably not unreasonable. And one thing to keep an eye out is more and more companies are adopting this. You will see more and more examples of how this impacts the industry that you're in, just from the filings that are coming out. Again, must disclose significant information to enable users of financial statements to understand the natures, timings surrounding those contracts, significant judgments, changes in judgments, determining the timing and satisfaction of performance obligations, and any assets recognized from the cost to obtain or fulfill a contract, whether or not you've got some cost yourselves that you have to put in on the front end. Maybe I'm agree to manufacture a certain part, certain widget for a customer. If I have costs that I'm going to have to incur on the front end in order to sell that widget over time, then that too would be something that would be disclosed if it is material. Another thing to keep in mind is when the entity satisfies the obligation. The term we always use, or that's kind of the slang for most manufacturers, is FOB shipping point, FOB destination. We talk about that all the time when we're doing audits. It's a matter of when that product, let's say it's eggs, for example. When it leaves the dock, are they your eggs or are they the customer's eggs? So that would be another factor that would have to be disclosed here as well. Significant payment terms, again, whether or not there's a significant financing component. Most of the time, these receivables would turn over fast enough that wouldn't be a factor. And then one thing that we hadn't touched on a whole lot, though, is whether or not there's any significant warranties. If you're manufacturing washing machines or something, that would be something to consider. The following are optional, though, for private companies. I do want to point that out, that there is a little bit of
and I think you're probably giving some relief to some people if they're on
the private company side.
The private company options do give a lot of the quantitative relief, the quantitative disclosures. Qualitative will still be there, but let Brian go through those.
Sure. But categories that depict the nature, amount, timing, and uncertainty of revenue recognition, relationship between disaggregated revenues and the information presented in each segment. For example, again, that's major product lines, geographical regions, markets, or customer types. So you may be asking yourselves, gosh, this is a lot. When is this going to happen? Or when do I need to worry about this? The original annual reporting periods that were issued in the original standard back in 2014 had it effective for public entities beginning after December 15th, 2016, and for private entities for periods beginning after December 15th, 2017. That's since been delayed. Public entities now are required to adopt this standard for years ending after December 15th, 2017. So for most people, that would be your December 2018 audited financial statements.
Correct.
And for private entities, that would be effective for your December 2019.
Now, one thing I have heard from some of the people that have early implemented or started the early implementation process is because they did feel like this is going to take a lot of analysis and a lot of work from the accounting staff, knowing that coming up shortly thereafter will be the lease accounting standards. They didn't really want both of those going on at the same time. So they went ahead and early adopted this. So that may be a consideration when you're looking at your workflow, is to consider, do I want to early adopt this?
Sure.
And again, for a lot of people, this is going to be more a matter of disclosures. A lot of them on the private company are going to be a qualitative disclosure. But it is something to think about on your accounting staff and how you want the workflow to go through.
Both these will be effective at or near the same time for a lot of entities. So again, it's just like we talked about in previous webinars with the leases. This will be here before you know it. In terms of adopting it, though, you've got a couple of different approaches. You must either retrospectively apply it to all periods presented in the financials. So if you're a public company and you present 3 years worth of income statements, you really have to be thinking about it right now. This period that we're in will most certainly need to be retrospectively accounted for or applied to, going forward in the year of adoption. The other concept or application would be to apply it based on a cumulative adjustment as of the adoption date by one or more of the following, and that would be by restating completed contracts, determining any variable consideration of those completed contracts and accounting for those, and disclosing for any price allocations that still are yet to be satisfied.
Well, Brian, we've gone through a lot of the standards, and I thought we'd end with a few just questions that maybe people have seen in their own life, and may give them some analogies of how could they see this coming through in their daily accounting lives. So the first example I want to go with is, what would a company such as AT&T, Verizon, Sprint do when you buy an iPhone? How would that be looked at?
Well, it won't be that simple, or it won't be as simple as it sounds like you just ring the register up and recorded all the revenue. The short answer is it depends. Um, in this case, they'll have to satisfy their performance obligation, including any variable considerations. And the amount is applicable or allocable to any delivered item or items that are limited to the amount that is not contingent upon delivery of additional items or meeting other specified performance obligations. So in English, the new 5 principles, not 4, but 5 principles will have to be applied.
Then the next example I was going to have is a real estate developer enters into a contract to sell space in a building to a restaurant. The restaurant makes a down payment to the developer and signs a non-recourse note with the developer for the balance of the contract. If the restaurant owner has no prior history in the business, you already know it's got a limited ability to pay, and the restaurant is located in a highly competitive area. Has revenue been recognized when the contract is executed?
In this case, no, since the payment is dependent on the restaurant's ability to repay, which is questionable. The developer only recognizes a deposit liability for the down payment. Another example, in this case, you have a tax update service, whereby you publish a book that is updated only annually, and also have online subscribers with updated material throughout the year. Do you have 1 or 2 revenue sources? When is revenue recognized for each? Well, the first source would be the book. In this case, you've got 2. And the customer will recognize revenue, the customer receives value, and then you would recognize revenue when the book is delivered. Revenue is recognized all at that time since the performance obligation has been satisfied. Since the online subscriber, in this case, receives value throughout the year, revenue is recognized throughout the year due to the customer simultaneously receiving and consuming the benefits provided by this subscription service.
Well, I think this is one of the best examples, really, because this shows an entity that really is in the same line of business. You know, they're selling product, they're selling thought product, really, tax books, but they're offering it in 2 different ways. How do you receive that product? So if you're somebody that maybe has 2 different lines of business, even though they're interrelated, you may be looking at, well, we need to be showing our revenue broken out separately. You probably should have in the past, but now you may have more disclosures to go through and more things to think about as you're lining out your revenue.
Yeah. In this case, they'll have to say that, you know, we not only sell hard copies, but also an online subscription. They may have to say, you know, what percentage of the revenue is coming from, a hard copy book versus an online subscription.
And as these models, revenue models continue to evolve in our society, you may see more people needing to make those decisions. It does give a user a sense of, well, what is going on in their business and how are things changing. So, Brian, we've given people a lot of information and some good examples. If you were on the inside on a company, from a company's perspective, what do they need to be thinking about and what do they need to be doing?
Well, step 1, identify your customer contracts. And that goes into, having a good understanding of who your customers are. Many entities, have major customers, for example, and you've got a pretty good handle on who your largest customers are and how you price those products and services and how often you get paid. But oftentimes it's some of these smaller ones that you may or may not know as much about because you're, just kind of handling the financing. Maybe they don't come up as much day to day. I try to focus on getting a handle on all of them and not just your largest ones as well, because I know that would be probably the first place a lot of people start. Similar to the leasing standards, you need to understand what your sales force is committing to. Are they committing to discounts, promotions, rebates, those sort of things? Oftentimes, particularly, we work with a lot of people that sell food. If you're selling to a Walmart, a Kroger, a Publix, Sam's Club, whomever, what sort of incentives are you giving those folks to buy your product, and how are you pricing those? Many times, and I know this, for example, a lot of your big food distributors and retailers don't necessarily subscribe to written contracts. I've heard that from many of our clients who say, well, so and so is not going to necessarily put that in writing. So many times it's going to be an email at best from your sales department. Oftentimes you're really going to have a face-to-face conversation with them about what sort of rebates, incentives, those sort of things are you providing in order to move product or services. So the other thing to do is determine what performance obligations you have with these customers. What are your commitments going forward in terms of not only those rebates, but any sort of volume commitments that are associated with that. And kind of touching on what TJ's saying, is it a situation where you're going to hit those targets over time, and you're pretty much obligated to give that discount? And also, are you satisfying revenue over a period of time, or upfront with the receipt of those goods or services? Lastly, but not least, reach out to Frost. This is a very in-depth topic. It's a new topic that everybody's going to have to deal with over the next 12 to 24 months. And as we said earlier on the front end, this was not designed to be a comprehensive discussion about it, but we really wanted to make everybody aware out there that the discussion is going to happen, and it's going to take not necessarily an hour, but hours to get your hands around this.
Yeah, Brian. As we come to the end, just to reiterate what Brian said, don't hesitate to reach out, whether it's to he or myself, and on the next slide will give us our information. But also, if you're a member at Frost or you work with Frost, don't hesitate to reach out to your client service representative, and they can work through this with you. It is it can be very cumbersome. So we certainly want to help. We certainly want to thank everybody who's listened and been in on this webinar. We will be putting it up online, and it will be available for others through our YouTube channel. So look for it there. And if you have any questions, again, please don't hesitate to reach out to either one of us. Thank you.
Thank you.